The Federal Reserve wrapping up its two-day policy meeting Wednesday, leaving short-term interest rates unchanged, but says it will be appropriate to raise rates when the Fed has seen, quote, some improvement in the labor market. For more analysis, Lindsey Piegza is here. She's the chief economist at Stifel Fixed Income. And Lindsey, some improvement in the labor market. What does that mean to you?
Well, I think this reflects the fact that the Fed consistently lowers their bar of expectations. Now, we know that the Fed has lowered their forecast for growth twice now this year, but they're no longer looking for robust further improvement. Now they're looking for some further improvement. So I think this reflects the fact that the Fed is lowering their expectations down to a more sluggish reality rather than maybe waiting for the economy to meet their heightened level of expectations.
And this decision to keep rates unchanged was unanimous. I mean, what does that tell you that none of the Fed members dissented?
Well, I think the fact that we did see that some language may have kept the hawkish members on board with this statement release. Again, not waiting for further improvement, but some further improvement. That may have quelled the concessions for the hawks on the Fed.
And Lindsey, our viewers are familiar with your stance on the rate hike timeline. You think September is out, December is out. You're actually looking at a 2016 rate hike. Give us your rationale.
That's exactly right. The committee was very clear that they recognized the underperformance of the economy, talking about household spending still being very moderate, business investment, exports still very sluggishly low, inflation still well below the committee's 2% target. So they're recognizing the underperformance of the economy, and this underperformance we do expect will keep the Fed on the sideline much longer than the market expects into 2016.
All right, now the Fed has been expecting a rebound in economic growth for the second quarter.
They have.
First quarter, they kept saying, well, it was transitory factors. That's why first quarter was weak.
Right.
Of course, we get the first reading on second quarter GDP tomorrow. How important will this number be for the Fed's rate hike timeline?
Well, I think the fact that we're going to see that second quarter GDP number come in around 2%, this undermines the expectations for a 2014 style rebound. And this puts more pressure than on the back end of the year, the latter 6 months, to really outperform. If we don't see 3.5, or 4% GDP in the latter 6 months of the year, the Fed really doesn't have a leg to stand on to justify a near-term rate increase. So again, I think a disappointing Q2 number really solidifies our argument that the Fed will remain on the sideline much longer than expected. Even
though there's this other argument that the Fed doesn't want to be accused of, keeping rates too low for too long.
Well, I think the risk of raising too soon and undermining the recovery, the very fragile recovery, is a much greater risk than waiting too long. The Fed can always raise more aggressively than they've laid out the pathway is going to look like. But to undermine the recovery and undo all of the stimulative policies that they've had in place for the past years, I think that's a bigger risk. And I think the Fed does not want to be responsible for undermining the recovery.
All right, just real quick, the market's reaction to all of this, I mean, do you think that initial rate hike is priced in at this point?
I think the rate hike certainly is priced into the bond market. I think looking at the weak fundamentals, yields would be 20 to 30 basis points lower. But when we look at the equity markets, I think a lot is driving the equity markets outside of fundamentals in the U.S. Certainly merger and acquisition activity, debt buybacks, that's really been fueling the equity market. But the fundamentals are much weaker.
All right, Lindsey, we'll leave it there. Lindsey Piegza, the chief economist at Stifel Fixed Income. It's great to see you. Thanks for joining us on Fed Day.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.